Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Arxis Inc., trading under the ticker ARXS. Arxis is executing an elite, technology-backed platform consolidation playbook, weaponizing its newly freed $1.1 billion in total available liquidity to accelerate its proprietary M&A engine. However, this premium growth thesis is currently being stress-tested by tight full-year execution hurdles, requiring an implied 39% adjusted EBITDA margin run rate and a lingering post-IPO gross debt balance of over $2.5 billion.
Man, that thesis statement really packs a serious punch right out of the gate.
Yeah, we're not pulling any punches today.
No, definitely not, because we're essentially looking at this industrial manufacturing company that, just hit the public markets back in April 2026. And they are carrying this financial architecture that just demands a really rigorous unpacking.
Right.
I mean, you don't just stumble into a 39% margin requirement or have $1 billion in liquidity sitting around by accident.
No, exactly. And let's translate that heavy financial artillery for you, the listener, right away. Because if you're joining us for this deep dive, your goal today is really to understand a newly public industrial compounder that operates, well, behind the scenes, almost entirely like a regulated monopoly.
Yeah. Regulated monopoly is the exact right way to phrase it.
Right. So we are going to dissect the company's sole source engineering moat, their proprietary pricing playbook, and those really complex post-IPO balance sheet mechanics. Because that's what makes this stock such a unique proposition in the aerospace and defense sector right now.
That really is unique.
Yeah. And, they priced their initial public offering at $28 a share. They raised over $1.2 billion. But before we get lost in the weeds of their leverage ratios or their M&A engine, I think we have to start with the physical reality of what this company actually builds.
Completely agree.
Because if you just look at a spreadsheet, you miss the entire story here.
You really do. I mean, the spreadsheet it's just a lagging indicator of the factory floor.
Right.
If we don't understand the actual physical product architecture, the financial multiples that they command will look, well, completely detached from reality.
Exactly. Like they're doing software numbers, but bending metal.
Yes. So to comprehend why Arxis can dictate the margins it does, we really must examine the foundational blueprint of their business operations first.
Okay, so let's establish what that product is, and more importantly, why their customers are structurally trapped into buying it. But I want to clear up a misconception right away for everyone listening.
Sure.
Arxis is not a prime contractor.
No, not at all.
Like, if I'm looking at an Air Force runway, they aren't the ones rolling complete F-35 fighter jets off an assembly line.
Right.
They aren't the ones launching entire orbital satellites into space. So where exactly do they fit into the hierarchy?
So, companies like Lockheed Martin, Boeing, Airbus, those are the primes.
Okay.
They construct the final massive multi-billion-dollar systems. Arxis operates in the crucial layers just beneath that surface.
So they're feeding the primes?
Exactly. They are an asset-heavy, highly specialized Tier 1 component manufacturer.
Tier 1. Okay.
Yeah. And in practical terms, that means they design and manufacture the proprietary, non-discretionary mechanical and electronic parts that go into those massive systems.
Okay, wait. When you say non-discretionary, I imagine we aren't talking about, cup holders in a commercial jet.
Definitely not cup holders.
Right. Are we talking about the granular, microscopic nervous system of these machines?
That is a highly accurate way to visualize it, yeah. We are looking at what they call extreme environment components.
Extreme environment.
Right. So on the electronic side, this includes things like high reliability connectors, specialized radio frequency, and microwave components.
Oh, like for radar.
Exactly. Used in advanced radar arrays. And microelectronic packaging that's designed to protect guidance computers.
Okay, and what about the mechanical side?
On the mechanical side, they manufacture precision bearings, really complex spring isolators, and high-performance elastomeric seals.
I want to pause on that phrase, extreme environment, because, to someone outside the aerospace industry analyzing this, a bearing is just a bearing, and a seal is just a piece of rubber, right?
Right.
What makes these parts so fundamentally different from something you'd buy from a standard industrial catalog?
Well, the difference really lies in the catastrophic consequences of failure.
Okay.
These components are engineered to survive the absolute most hostile conditions imaginable on or even above the planet.
Give me an example.
Sure. Consider a fighter jet executing a really high-speed maneuver.
Okay.
The electronic connectors that are transferring data from the pilot's controls to the ailerons on the wings, they have to withstand intense, sustained G-forces.
Right, massive vibration.
Massive vibration without even a microsecond of signal loss.
Mm-hmm.
Or consider a satellite.
Okay.
The microelectronic packaging up there has to operate flawlessly in the absolute vacuum of outer space.
Which is brutal.
It is. Enduring relentless solar radiation and thermal spikes that go from, extreme freezing to blistering heat in a matter of literally minutes.
Right. So if a standard commercial-grade rubber seal fails on a hydraulic system in, say, a tractor, the tractor leaks some fluid and stops working.
Exactly. You call a mechanic.
But if that same standard seal is placed in an aircraft at 35,000 feet, what happens?
The aircraft loses hydraulic pressure, the control surfaces completely lock up, and the plane goes down.
Wow.
It is literally that binary. ARXS manufactures the specific component that guarantees that sequence of events does not happen.
Okay.
And that mission-critical life-or-death nature of the product is really what leads us to the brilliance of their commercial model. It's a concept we refer to as the design-in lock.
Okay, let's unpack this for the listener. Think of it like designing a $100 million skyscraper where the entire structural integrity relies on a very specific $500 proprietary bolt.
Yes, great way to put it.
Right. If you want to use a cheaper bolt later on, you have to recertify the entire building.
The skyscraper analogy captures the dynamic perfectly. Let me explain the actual mechanics of how ARXS secures that position.
Please do.
They execute this lock by physically embedding their workforce into the customer's workflow.
Wait, physically? Like they're in the building?
Yeah, ARXS employs over 500 multidisciplinary engineers. So when a prime contractor, let's say General Electric Aviation, is in the initial blueprint and design phase of a next-generation commercial jet engine.
Before it's even built.
Way before. ARXS embeds its engineers directly alongside GE's teams.
Wow.
They don't wait for GE to ask for a part out of a catalog. They actively co-develop a custom solution to solve a highly complex emerging performance challenge right there at the drawing board.
So they aren't functioning as a traditional vendor handing over a spec sheet.
Not at all.
They are literally co-authoring the blueprint of the machine alongside the customer before the machine even exists in the real world.
That co-authorship is the crucial mechanism here. Because once that specific proprietary ARXS part is drawn into the platform's official bill of materials, this immense regulatory mechanism kicks in.
This certification.
Right. The entire completed platform must receive formal regulatory certification to be legally sold or operated. In commercial aerospace, that is governed by the Federal Aviation Administration, the FAA.
And in defense.
In defense, it requires sign-off from the Department of Defense.
And from everything I've seen in the industrial sector, getting that level of government certification is, well, neither a cheap nor a fast process.
Oh, it is an agonizingly slow, incredibly expensive hurdle.
Yeah.
It takes years of stress testing, endless data submission, and bureaucratic review. It costs millions of dollars. So, applying your skyscraper analogy to an aerospace timeline, imagine a prime contractor is 5 years into a multi-decade production run of a new missile system.
Okay, they've been building it for years.
Right. And a competing supplier approaches them and says, hey, we reverse engineered the ARXS electronic connector, and we can make a similar one for 15% less money.
So the prime contractor would have to look at the math on that.
And the math is absolutely terrifying for the prime.
Why?
Because to make that switch, to save that 15%, they would have to completely halt their active production line.
Oh, wow.
Yeah, stop everything. Then pay their own engineers to redesign the subassembly to fit the new competitor's part.
Which takes time.
It takes months. And then they have to spend millions of dollars and potentially years of time putting the entire missile system back through the DoD's regulatory type certification process.
So it would literally cost them tens of millions of dollars in downtime and testing just to save a few $100 on a single component.
Exactly.
It is entirely financially irrational to ever make that switch.
Which is precisely why market displacement almost never happens once an ARXS part is designed in. This regulatory friction creates a virtually indestructible barrier to entry for any lower-cost competitors.
It structurally traps the customer.
It does, and the result of this trap is a level of contract concentration that just completely defies standard industrial manufacturing norms.
How so?
Well, if you look at traditional competitive bidding cycles, suppliers are constantly squeezing their own margins, right?
Right, trying to be the lowest bidder.
Exactly, undercutting each other to win the next annual contract. But ARXS operates in an alternative reality. Because of this design-in lock, Arxis acts as the absolute sole provider for over 80% of its total revenue.
Wait, 80%.
Over 80%.
For the listener taking notes, I really want to highlight that metric because it is the absolute bedrock of this entire deep dive. Over 80% of the revenue Arxis generates comes from parts where they are the absolute only supplier in the world legally permitted to provide that part for that specific platform.
It's staggering. And furthermore, roughly 90% of their total revenue is derived from proprietary products they uniquely designed and developed themselves.
So they own the IP.
They own the IP. This sole source positioning prevents the market share erosion that usually just plagues manufacturing businesses.
When you are the only game in town and the customer faces massive financial and regulatory penalties for leaving,
You essentially have monopoly pricing power.
you are granted near monopoly pricing power, yes.
It sounds like a highly protected oligopoly environment. I mean, they own the underlying intellectual property, they have the regulatory blessing wrapped around them like a shield, and the customer is locked in for the multi-decade life cycle of the jet or the satellite.
That's the setup.
But having a moat is only step one, right? The next massive question we need to answer in this deep dive is how they actually exploit it.
Right, the execution.
Exactly. How does Arxis actually execute on that captive audience?
Yeah.
Because extracting massive profitability without completely breaking the customer relationship requires a very delicate, highly specific operational machine.
It does require a specialized engine. And for Arxis, that operational machine is called the Arxis EDG system.
The EGE system.
Yeah.
Okay. Yeah. And to understand how EDG works, we really have to look at how Arxis is built corporately. They are not a single monolithic entity operating out of one giant factory in Ohio.
Right, they're a roll-up.
Exactly. They are an aggressive roll-up. Under the ownership of their private equity sponsor, Arcline, Arxis has expanded by gobbling up smaller companies. They've executed over 30 acquisitions since 2019.
So they are essentially an aggregator of niche intellectual property.
That is their true corporate identity. Today, Arxis is comprised of 47 specialized, highly boutique component brands.
47 different brands.
Yeah. And these 47 brands are built upon 67 foundational proprietary technologies. Now, standard corporate logic dictates that managing 47 distinct entrepreneurial companies would be an absolute decentralized nightmare.
Oh, yeah. Usually you'd expect massive administrative redundancies, isolated sales teams not talking to each other, just a total lack of corporate synergy.
Exactly, which is where this ADG software comes into play.
So explain how a data system actually prevents that chaos.
Well, ADG is their proprietary data-driven business system. It acts as the central nervous system unifying this entire decentralized structure.
Okay.
It leverages real-time data analytics to enforce corporate accountability across all 47 brands. But its most vital function, and honestly the reason it drives so much revenue, is how it enforces proactive, team-based cross-selling.
Walk me through the mechanics of that cross-selling. Like, how does a piece of software actually convince an engineer to sell more parts?
It tracks visibility and aligns financial incentives.
Okay.
The EDGE system systematically logs thousands of individual statements of work across the entire portfolio in real time. It acts almost like a hyper-advanced air traffic control tower for their sales and engineering.
So everyone sees what everyone else is doing.
Right. It allows cross-functional teams to see exactly where one specific brand is currently embedded with the customer, and it instantly flags opportunities to sell another brand's component into that exact same platform.
That's smart.
But as you know, data is useless without motivation.
Right, you have to pay them.
Exactly.
Yeah.
Arxis backs this visibility up with direct, localized compensation. More than 450 employees, which importantly includes the multidisciplinary engineers and technical sales staff, are eligible to receive incentive compensation based purely on securing new business wins.
I see. So an Arxis engineer who is currently embedded with Northrop Grumman actively designing a mechanical seal for a new drone is financially incentivized by the software to look at the adjacent blueprints and say, wait, we also own an electronic connector brand that would solve the vibration issue on this radar array over here.
Exactly the mechanism. They have built an internal new business engine. They are literally turning their engineers into highly technical sales scouts.
Wow.
And this proactive commercial culture expanded their cross-selling pipeline from roughly 50 identified opportunities back in 2021 to over 2,000 active tracked opportunities today.
2,000. That's a massive jump.
Massive.
Yeah.
But identifying an opportunity and getting it designed in is only the first half of the equation, right?
Sure.
The real financial gravity is generated when they price that opportunity. This is where we really had to discuss their VPC, pricing playbook.
Right. VPC stands for volume, price, cost. Break down how that algorithm actually functions on a day-to-day basis for them.
The Arxis 80GE system relies on this VPC algorithm to force organic margin growth. Because Arxis parts are incredibly mission-critical, but represent a microscopic fraction of a total platform's cost.
How microscopic are we talking?
Frequently less than 0.01% of the total bill of materials.
Wow. Just a rounding error for the prime.
Exactly. And because of that, they are able to successfully execute value-to-cost pricing.
Meaning they aren't just looking at the cost of the raw aluminum, adding a 10% margin and selling it.
Oh, no.
They are pricing based on the immense value of preventing a multi-million-dollar catastrophic failure.
That is the core philosophy. However, they also have to protect these elite margins from the physical realities of global manufacturing.
Like supply chain stuff.
Right. They have to deal with raw material inflation, supply chain bottlenecks, increased freight costs, labor wage hikes, all of it. To shield themselves, Arxis utilizes a very specific, highly agile contracting model.
Okay.
While their parts are embedded in platforms that will fly for decades, their CEO, Kevin Persmus, has noted that they strongly prefer to conduct their actual business contracting on a PO-to-PO basis.
Purchase order to purchase order.
Yes.
How does that contrast with how standard aerospace suppliers usually operate?
Well, standard suppliers often get pressured by primes into signing long-term agreements, or LTAs.
LTAs.
These LTAs might lock in pricing for 5 to 10 years. The prime loves it because it guarantees cost predictability for them.
But for the supplier.
The supplier hates it because if the cost of specialized aerospace-grade rubber spikes by 30% in year 2, the supplier just has to eat that massive margin compression. Arxis, for the most part, avoids LTAs. The PO-to-PO model gives them incredible operational agility. Because they are the sole source provider, they can instantly pass along those inflation and supply chain cost increases to the customer in the form of a price hike on the very next purchase order.
Let's ground this in reality by looking at how this velocity actually played out during the first quarter of 2026, because the numbers they reported are staggering.
They really are.
They posted a 17% baseline organic growth rate. But the fascinating detail here is that roughly 1/3 of that entire organic growth surge was driven purely by mid-single-digit price realization.
Which means they're just turning the dial on price, right? Executing the VPC playbook, and that revenue flows straight down the income statement without requiring them to build a single extra part.
And this pricing leverage allowed them to expand their blended gross margins to an elite 51.2% in Q1.
Unbelievable.
I mean, that translates to $234.8 million in gross profit in a single quarter for a company that, bends metal and molds rubber.
Yeah, a 51.2% gross margin in heavy industrial manufacturing is incredibly rare. You usually only see those numbers in software or like asset-light tech.
Right, SaaS companies.
Exactly. Here, it is a direct mathematical reflection of their sole source moat and that PO-to-PO pricing agility.
I have to push back here, though, because this is where the thesis feels a bit risky to me as an analyst.
Sure, let's hear it.
If Arxis keeps aggressively hiking prices PO-to-PO on the U.S. government and the top defense primes, aren't they going to trigger a massive retaliation?
It's a valid question.
I mean, if I am a procurement officer at the Department of Defense and Arxis keeps raising the toll on my purchase orders, eventually I'm going to demand a regulatory audit, or I'm going to force a prime contractor to spend the money to recertify a competitor just to break the monopoly, right?
But that tension is the most critical risk inherent in what we call the proprietary Tier 1 playbook. You are constantly walking a high wire between maximizing shareholder value and alienating a captive customer base. But this is where understanding the extreme value-to-cost ratio provides the ultimate counter-argument.
How so?
Let's say Arxis raises the price of a critical seal by 10%. That seal still represents less than 1/100% of the total cost of the jet engine.
Right.
For the prime contractor and the DoD, the bureaucratic nightmare, the severe engineering delays, and the tens of millions of dollars required to halt production, strip that part out and recertify a cheaper alternative. It will always drastically outweigh the cost of simply paying Arxis's increased toll.
So they just pay it.
The friction to change is just too high. As long as Arxis keeps their price hikes somewhat within the bounds of standard inflation and justifiable value add, the primes will grumble, but they will absorb it.
Okay, so their organic engine is humming, driven by that pricing power and cross-selling. But organic growth alone, even at a healthy 17%, is rarely enough to satisfy the aggressive demands of the public markets, especially for a company carrying a premium IPO valuation.
Very true.
They have to grow faster than organically possible.
And to justify their multiple, Arxis has to scale their footprint rapidly. They execute that by acquiring new targets, integrating their intellectual property, and plugging them into this exact EDGE system.
And that transitions us into how their proprietary M&A engine actually works. We need to look at how Arxis ingests new boutique brands and accelerates their segment velocity.
Let's do it.
Let's break down that Q1 revenue surge to see the engine in action. Total revenue surged 21% year over year to $458.9 million. We just established that 17% was the baseline organic growth.
Right.
That leaves the remaining 4% of growth, which was inorganic, driven directly by recent M&A activity.
Correct. That 4% translates to roughly $13.7 million in newly acquired revenue and about $6.4 million in added gross profit just for the quarter.
Nice.
And a highly illustrative driver of this inorganic surge was their acquisition of a specialized company called Micro-Tronics.
Let's isolate the Micro-Tronics deal because I think it serves as a perfect case study for their ingestion playbook.
It really does.
Arxis completed this acquisition on January 5, 2026, paying $71.6 million in cash. What specific capabilities did they actually buy for $71 million?
They purchased highly specialized, extreme environment product capabilities. Specifically, Micro-Tronics designs and manufactures mission-critical, elastomeric, rubber-to-metal bonded defense seals and diaphragm assemblies.
Say that again?
Elastomeric rubber-to-metal bonded defense seals. They also specialize in high-precision electrical discharge machined components.
Okay, elastomeric rubber-to-metal bonded defense seals. That sounds incredibly niche. Why is that specific technology worth paying a premium for?
Because bonding an elastomer, which is a flexible rubber material, to a rigid metal component in a way that will never fail under extreme stress is chemically and mechanically incredibly difficult to manufacture reliably.
Oh, I see.
Yeah. These specific seals and diaphragms are engineered to prevent catastrophic failure in advanced propulsion systems.
Give me a visual.
Imagine the complex hydraulic systems operating inside a missile or a high-altitude aircraft. They're dealing with massive, fluctuating pressure differentials and temperatures that drop far below freezing.
Right.
If a seal becomes brittle and fails in that environment, the propulsion system loses pressure instantly and the platform is lost. Micro-Tronics holds the proven intellectual property and the proprietary manufacturing techniques to create the seals that simply do not fail.
So Arxis buys this proven IP for $71.6 million. They absorb it directly into their mechanical components segment. What is the physical mechanism of integration? Like, what happens on day two?
On day two, they immediately plug the Micro-Tronics product catalog into the Arxis EDGE system.
Just flip the switch.
Just flip the switch. Recall that vast cross-selling pipeline we discussed earlier.
Yeah.
Instantly, the 450-plus incentivized sales staff and embedded engineers across the entire Arxis empire now have a new, highly specialized, high-margin elastomeric seal in their toolkit.
Oh.
An engineer working on a completely different subsystem for Boeing can now look at the blueprints and cross-sell this newly acquired Micro-Tronics seal through Arxis's existing deeply entrenched supply contracts.
So they bypassed the years of relationship building that Micro-Tronics would have had to do on their own.
Completely bypass it.
They just open up their massive corporate distribution pipes and blast the new product through to every defense prime.
That is the ultimate leverage of the platform. And the illustrative data from Q1 demonstrates just how violent this velocity can be.
What were the numbers?
Plugging Micro-Tronics into the EDGE pipeline instantly drove Arxis's mechanical component segment to a blistering 22.5% revenue surge for the quarter.
That is a massive injection of segment velocity. But it wasn't just a bump in top-line revenue, was it? The impact on their profitability margins was equally aggressive.
It was. The addition of these highly technical, high-margin seals, combined with immediately applying the VPC pricing playbook to Micro-Tronics' legacy contracts.
Raising the prices.
Exactly. Alongside targeted corporate cost reductions, drove a massive 700 basis point adjusted EBITDA margin expansion within the mechanical segment.
For context, for those listening, 700 basis points is a full 7% jump in profitability in just 90 days.
That's huge.
That pushed the mechanical segment's overall adjusted EBITDA margin up to 37.6% in a single quarter.
And here's where we can extrapolate the internal runway for this company. Even operating at that blistering 37.6% margin, the mechanical segment is actually still lagging behind Arxis's other main division.
The electronic segment.
Yes, the electronic component segment, which operated at an incredible 42.8% margin during the exact same quarter.
Let's frame what that gap means for someone analyzing their potential.
It signifies a massive reservoir of untapped internal profitability. Management has gone on record explicitly stating that there is no structural reason the mechanical segment cannot eventually be optimized to reach absolute parity with the electronic segment's 42.8% margins.
So there's more juice to squeeze.
Much more. As they continue to ingest new acquisitions like Micro-Tronics, apply their cost synergy levers, and push higher volumes through the EGE system, they possess a clear, defined internal path to pull their blended corporate margins even higher over the next few years.
Okay, the operational narrative here is incredibly bullish. I mean, they have an unbreakable sole source moat, elite pricing power that customers are basically forced to swallow, and an M&A engine that immediately accelerates both revenue and margins.
It looks perfect on paper.
Which raises a massive, glaring question for anyone who actually opens up their historical S1 filing.
You are looking at the historical net loss.
Exactly. If this business is so exceptionally profitable at the gross margin and operational level, why on earth did Arxis print a historical GAAP net loss of $4.3 million in the first quarter of 2025? Where was all that operational cash actually bleeding out?
The cash was bleeding out to the banks.
Yeah.
To understand this paradox, we have to transition our focus away from their factory floors and expose the corporate balance sheet. We really have to look at the massive private equity debt load that they were carrying and how the April 2026 IPO fundamentally repaired it.
Let's run some deleveraging forensics on this. Because the IPO wasn't just about cashing out, it fundamentally altered the capital structure and the risk profile of this entire enterprise.
It changed everything.
Let's revisit the mechanics. In April 2026, Arxis made its public debut. They priced the offering at $28 per share, and they raised a massive $1.22 billion in clean net proceeds.
Right. And observing how management deployed that $1.22 billion is arguably the central catalyst for the stock's current narrative.
What did they do with it?
Well, Arxis didn't take that $1 billion and decide to build a massive new headquarters or immediately swing for the fences by buying a rival conglomerate.
Right.
They used the vast majority of it, specifically $946 million of the IPO cash, to directly retire their senior secured term Loan B debt. They executed this massive paydown across 2 post-quarter tranches.
Before we talk about the impact of that paydown, let's explain what a term Loan B actually is for the listener who might not be deep into corporate finance. Why is this specific type of debt so restrictive?
A term loan B is a specific type of syndicated institutional loan, heavily utilized by private equity firms when they are executing leveraged buyouts or massive roll-ups like Arxis.
Okay.
It typically carries higher yields and floating interest rates, meaning as macroeconomic interest rates rise, the cost of servicing that debt becomes heavier and heavier. Arxis was carrying a gross debt balance of over $2.6 billion at the end of Q1, largely tied up in these instruments.
So it's essentially like carrying a massive, high-interest corporate mortgage that constantly fluctuates with the market.
That's a great analogy.
By taking the IPO cash and instantly vaporizing $946 million of that principal, they completely rewrote their risk profile overnight.
They absolutely did. Before the IPO cash was deployed, their net leverage, which is the standard ratio of their net debt divided by their Adjusted EBITDA, was sitting at a highly restrictive 4.0x.
4 times leverage.
Yeah. And for a heavy industrial manufacturer subject to supply chain shocks, carrying 4.0x leverage means you are operating in a straitjacket.
Because the interest payments eat everything.
Exactly. A significant mandatory portion of your operating cash flow is legally spoken for every single quarter just to service the interest payments on that debt. You have very little room to maneuver if the macro environment turns against you.
It totally throttles your ability to invest in R&D or pursue opportunistic M&A.
Precisely. But by aggressively deploying that $946 million paydown, they collapsed their net leverage down from that restrictive 4.0x profile to a highly flexible, comfortable 2.0x.
Wow. Let's calculate the pro forma impact on their daily operations, because this is where the cash flow story explodes and explains that historical net loss. In Q1 of 2026, before the IPO cash could be legally deployed, how much was Arxis paying just to keep the banks happy?
They paid a crippling $43.96 million in interest expenses for that single quarter.
Almost $44 million out the door in 90 days, producing zero value for the actual company, just to carry the debt burden.
Correct. But with that $946 million principal reduction finalized, we can model a massive permanent drop in those obligations heading into the second quarter.
What's the new number?
The math implies an immediate 31% drop in quarterly interest expenses. They're going from that $43.96 million penalty down to a modeled run rate of approximately $30.3 million per quarter.
When you annualize those savings, the debt retirement implies that they have permanently removed over $70 million in annual cash interest expenses from their balance sheet.
Yes.
That is a staggering amount of capital to suddenly have at your disposal.
It is entirely transformative for them. It is capital that drops straight to the bottom line without requiring any increase in sales or operational efficiency.
It's just free money now.
Essentially, yes. That newly freed cash flow is exactly why we saw them swing violently from that $4.3 million net loss in Q1 of 2025 to a massive GAAP net income of $53.3 million in Q1 of 2026. The operational engine was finally unchained from the private equity debt anchor.
But hold on, let's look at the remaining capital. They raised $1.22 billion in net proceeds. They spent $946 million retiring the term loan. What happens to the remaining cash?
The remaining $275 million was retained purely as cash on the corporate balance sheet.
Okay.
And this is where the premium growth thesis accelerates into its next phase. When you combine that $275 million in newly retained cash with their existing undrawn revolving credit facility and their delayed draw term loan, Arxis now weaponizes a $1.1 billion total available liquidity pool.
A $1.1 billion war chest entirely dedicated to feeding their proprietary M&A engine.
That is the objective. And the crucial factor here is that they do not have to hunt for these acquisition targets on their own.
Why not?
Because Arxis operates in a highly symbiotic partnership with their private equity sponsor, Arcline. Despite the IPO, Arcline still retains 99% of the voting power. And Arcline employs a dedicated team of over 60 investment professionals whose sole full-time focus is underwriting targets for the portfolio. They are currently evaluating a massive pipeline of over 1,500 proprietary targets.
So it's a division of labor. Arcline acts as the scouting department doing all the financial underwriting and due diligence, and Arxis acts as the operational machine, providing the integration and the EGGE software system once the target is acquired.
It is a highly repeatable M&A engine. And they deploy this $1.1 billion war chest based on very strict, disciplined financial hurdles.
What are the hurdles?
They evaluate every target against two metrics. First, EBITDA acceleration. Can Arxis' operational team grow the target's EBITDA faster than the base Arxis business is growing?
Okay, that makes sense.
And second, multiple reduction. Can they execute the VPC pricing playbook and cost synergies fast enough to buy down the purchase multiple to less than 10x within 36 months of closing the deal?
Let me summarize this post-IPO reality, because it is a formidable setup. They now possess a repaired balance sheet with 2.0x leverage. They have $70 million in newly freed annual cash flow, and they sit on a $1.1 billion liquidity war chest backed by an army of 60 private equity scouts analyzing 1,500 targets.
It is an incredibly aggressive posture.
Yeah.
However, it raises the next critical question we must evaluate in this deep dive. With an aggressive M&A pipeline and a premium valuation multiple to defend, can the underlying foundation actually support this weight?
That is the ultimate question, because if the core business falters, if they can't sell the parts they already make, all that M&A liquidity won't save them.
Right.
If you are analyzing this, you need to know if the visibility of their future revenue is secure. So we need to transition to examining their firm backlog and the underlying end market architecture. Let's look at the order book.
The structural visibility of their order book provides a massive layer of defense here. Arxis entered 2026 with a $1.2 billion firm backlog. And despite printing record revenue in the first quarter, they maintained a positive book-to-bill ratio.
Let's explain what book-to-bill implies for a manufacturer, for those who might not know. It's essentially comparing the rate at which new orders are coming in versus the rate at which finished products are shipping out, right?
Exactly. Think of their factory capacity as a bathtub.
Okay.
The water flowing in from the faucet represents new orders, the book. The water draining out represents fulfilled orders and revenue recognized, the bill.
Got it.
A positive book-to-bill ratio means the water is flowing in faster than it is draining out. Even while shipping record volumes, they brought in more new orders than they completed, further growing that massive backlog.
But the most crucial de-risking metric for 2026 isn't just the total size of the backlog, right? It's how much of their immediate future is mathematically locked in. Management initiated a full-year top-end revenue guidance ceiling of $1.88 billion. That is a massive operational target to hit in their first year as a public company.
It is a steep target, but here is the specific data point that secures immense confidence in their ability to hit it. As of May 2026, Arxis had already locked 90% of its projected full-year revenue into its firm backlog.
I want to underline that, 90%.
Yeah.
We are analyzing a company where the year is only half over, and yet 90% of the money they need to hit the absolute ceiling of their own guidance is already contractually booked, signed, and waiting in the queue.
It provides an incredibly defensive floor against demand volatility. To understand the resilience of that backlog, we really have to map this revenue baseline across the three core end markets they service.
Break down that market architecture for us. Where is this demand actually coming from?
The primary driver is defense and space, which represents 47% of their total sales volume. This is their largest segment, and it is currently benefiting heavily from an ongoing cycle of global military modernization and massive investments in missile defense systems.
Right.
They're deeply aligned with the traditional legacy primes, Lockheed Martin, RTX, Northrop Grumman. But crucially, they're also aggressively supplying components to the emerging neoprimes.
When you say neoprimes, you mean the new wave of agile defense tech companies like Anduril, Shield AI, and Castellian.
Correct. And the brilliant part of Arxis's positioning is that they are entirely agnostic to who ultimately wins the defense contract.
Oh, because they supply both sides.
Exactly. Whether the Pentagon decides to buy a legacy Lockheed Martin system or an autonomous drone swarm from Anduril, both platforms require Arxis's extreme environment, high-reliability components to function. They supply the arms race, regardless of who wins it.
It's the classic strategy of selling pickaxes during a gold rush.
Precisely.
What makes up the rest of the revenue?
The second major end market is industrial technology, sitting at 30% of revenue. This segment is vital because it balances out the cyclicality of defense spending.
What are they doing there?
Here, they're supplying extreme environment sensors and automated components to medical technology companies, specifically for complex robotic surgical instruments and implantable devices.
Wow. Okay.
They also supply the semiconductor testing facilities, where standard commercial parts completely break down under the high voltage and continuous friction of 247 chip testing.
And the final piece of the architecture?
Commercial aerospace, which account for the remaining 23% of revenue. This segment is heavily driven by the massive, multi-year delivery backlogs currently sitting at Boeing and Airbus.
Right. They can't build planes fast enough.
Right. Furthermore, as airlines hold on to their older planes longer, it extends the aftermarket repair cycles for commercial engines, driving continuous demand for Arxis replacement parts.
So when you look at this architecture, 90% of revenue contractually locked in, decades-long defense modernization cycles, and massive commercial aerospace backlogs, I have to ask. Does this firm backlog essentially make Arxis immune to short-term macroeconomic turbulence? If we hit a recession tomorrow, are they bulletproof?
Immune is a dangerous word in financial analysis, and we really must temper that excitement.
Okay, let's temper it.
Yes, the massive backlog provides severe structural insulation from demand shocks. If the broader economy dips into a brief recession, Lockheed Martin is not going to suddenly cancel a multi-billion-dollar, decade-long missile program.
Sure.
And Boeing is not going to stop building the commercial planes that airlines have already paid deposits for. The demand side of the equation is remarkably secure. However, Arxis is still a physical manufacturer. Their core vulnerability does not reside on the demand side. It resides on the supply side.
I see. You're talking about physical supply chain constraints and the reality of moving materials around the globe.
Exactly. The backlog is only a theoretical number until they can physically build, test, and ship the parts.
Right.
If Arxis faces acute, prolonged shortages in specialized aerospace-grade raw materials, like specific titanium alloys or highly refined elastomers, or if physical supply chain bottlenecks throttle their factory floors, their ability to convert that massive $1.2 billion backlog into actual recognized cash could be severely delayed.
So the revenue is contractually protected, but the timing of the cash flows is still entirely subject to the physical realities and constraints of global industrial manufacturing.
That is a crucial defining distinction. The demand is locked, but flawless physical execution is still absolutely required. Which brings us to our final synthesis.
Yes, we need to deliver the final verdict and outline the investment case. It is time to bring all these complex mechanics together. We have to weigh these elite transdime-style economic moats against the aggressive multiple of the stock to deliver a clear verdict for the listener analyzing this space.
We have meticulously established the operational foundation and the balance sheet repair. Now we must evaluate what is required from management to actually justify buying the stock at this specific post-IPO inflection point.
I want to offer a final summary analogy that I think perfectly encapsulates the bull case for Arxis. Let's pull all this together. Think of Arxis as a vertically integrated intellectual property toll road.
I like that.
Once an aerospace prime contractor decides to start driving down their specific highway to build a new platform, because Arxis holds the blueprint and the regulatory certification, there are 0 exit ramps. The prime has to pay Arxis's required toll year after year, decade after decade, just to keep their platform operational.
The toll road is an excellent visualization of the design in lock and their relentless sole source pricing power. However, to maintain a rigorously balanced synthesis, we must clearly outline the strict execution hurdles required to justify their premium market valuation.
Right.
The market is currently pricing in near perfection, and Arxis faces 4 distinct, severe execution risks that we must define.
Let's break down those 4 specific risks. What is risk number 1?
Risk number 1 is the amortization drag. Because Arxis is an aggressive aggregator of intellectual property through constant M&A, they carry a massive intangible asset base, things like goodwill and acquired patents, on their balance sheet.
Okay.
Under GAAP accounting rules, this resulted in an intense $36.0 million non-cash amortization drag in just the first quarter of 2026.
Let's explain that for a second. It's a non-cash accounting penalty, meaning they aren't actually writing a check for $36 million. It's just a required depreciation on paper. Why is that a risk?
It is a risk because this massive quarterly paper penalty severely depresses their officially reported GAAP operating income.
Oh, I see.
If you have algorithmic trading models or surface-level investors screening for traditional price-to-earnings ratios based strictly on GAAP net income, Arxis looks artificially expensive or unprofitable. You have to do the deeper forensic work to uncover the true cash-generative power of the business, which deters a certain class of investors.
That makes sense. It requires a sophisticated allocator to look past the headline numbers. What is risk number 2?
Integration friction. Managing a highly decentralized roll-up of 47 individual boutique brands requires flawless operational oversight.
Right. Keeping the plate spinning.
If Arxis aggressively uses that $1.1 billion war chest to acquire companies too quickly, they risk severe indigestion. If the Arxis EDGE system fails to seamlessly integrate thousands of new entrepreneurial employees without bogging them down in suffocating corporate bureaucracy, they could destroy the very agility that made those targets valuable in the first place.
They have to integrate the IP without killing the culture. What is the third macro risk?
Macro vulnerability. Despite the 90% locked backlog, they remain heavily structurally exposed to the U.S. federal government.
Always a risk.
Continuing federal budget resolutions, political gridlock leading to defense spending caps, and physical supply chain inflation remain persistent macro threats. These factors could easily defer contract award timings and throttle their factory production velocity, pushing anticipated revenue out into future quarters.
And finally, risk number 4, which mathematically seems the most daunting of all. The operational hurdle.
Yes. To justify their premium valuation, Arxis must clear their strict top-end Adjusted EBITDA guidance ceiling of $730 million for the full year. Management has publicly committed to hitting that number. To do so, they must maintain an incremental margin conversion of over 50% on all new organic growth.
Let's do the actual math on that implied margin because the steepness of the climb is intense. They printed $175.2 million in Adjusted EBITDA in Q1. To hit the $730 million ceiling by year-end, they need to generate $554.8 million over the final 3 quarters.
Right.
When you divide that required profit by their remaining revenue target, it means Arxis must operate at an implied 39.0% Adjusted EBITDA margin run rate for the entire remainder of the year.
Operating at a 39.0% margin in heavy industrial manufacturing requires absolute unforgiving operational perfection. They cannot afford a single misstep in their VPC pricing algorithm, their supply chain management, or their cost reduction strategy.
This is a tightrope walk.
If raw material costs spike unexpectedly, or if cross-selling velocity slows down even slightly, they will miss that target, and the market will likely punish the premium multiple.
So, weighing the intellectual property toll road against these 4 severe execution risks, what is your final verdict?
The final verdict synthesizes why an enterprise backed by these transdime-style economic moats justifies buying the stock at its current post-IPO inflection point. Yes, the execution hurdles are mathematically tight, and the margin requirements demand perfection. But the combination of their intense, unbreakable sole-source pricing power, a highly de-risked 90% booked revenue runway, and the structural removal of their historical suffocating debt burden makes them a premium compounder.
Yeah.
They're entering a multi-year defense and commercial aerospace upcycle, armed with a newly freed $1.1 billion war chest and an operational machine that is mathematically proven to convert volume into massive margin expansion. For allocators seeking elite, highly cash-generative industrial technology assets, the downside risk is clearly defined by the backlog, and the upside portfolio is structurally protected.
It is a highly compelling synthesis. They have successfully built an incredibly defended fortress of intellectual property, and they now have the liquidity to violently expand its borders. But as we wrap up this deep dive, I want to leave you, the listener, with a larger, unexplored question to ponder as you evaluate this space.
A provocative thought to end on.
Exactly. We have talked extensively about the awesome financial power of their sole source moat, but let's extrapolate this logic out a decade. If Arxis continues on this aggressive post-IPO M&A path, utilizing that billion-dollar war chest to systematically consolidate the entire middle tier of aerospace component intellectual property, will they eventually become an unavoidable systemic bottleneck for U.S. defense modernization?
It is a fascinating systemic risk to consider. I mean, if you systematically roll up and own 80%, 90% of the critical proprietary components required across every major military platform.
Could their massive accumulation of sole source pricing power eventually invite intense regulatory antitrust scrutiny from the very government that relies so desperately on their parts? It is the ultimate paradox of the defense contractor. You want to make yourself utterly indispensable, but if you become too indispensable, you become a systemic vulnerability to the Pentagon itself. Keep questioning the consensus. Thank you for joining us on this deep dive.
Thank you.